Thank you so much, everyone, for joining us for today's Ask Me Anything webinar with Mickayla Rosard, partner at Groove Capital, an early stage VC fund based locally in the Twin Cities. Before we dive into the questions with Mickayla, Medical Alley starts would not be possible without some of the sponsors that have stepped up and invested in the local ecosystem and Medical Alley starts. We have a short video for introductions of each of them.
Hi, my name is Paul Carlson. I'm a principal at CLA. CLA is a professional services firm that provides industry-focused outsourcing, audit, tax, wealth advisory, consulting, and digital services to healthcare and life science companies, including startups. We pride ourselves in working closely with entrepreneurs and business owners to help preserve capital, manage and mitigate financial risk, and achieve the future they envision. If you'd like to learn more about CLA, you can visit claconnect.com or contact me after the event. Medical Alley would also be glad to connect you, or you can find me on LinkedIn. Thank you.
Perfect. Hi, my name is Morgan Evans, and I am the founder of Avio MedTech Consulting. We provide fractional services in the areas of quality, regulatory, and engineering to medtech startups. If you would like to learn more about Avio, we ask that you visit our website at www.aviomedtech.com or contact me after the event. Medical Alley would also be happy to put you in touch with us, or you can reach out on LinkedIn. Thank you.
Hi, my name is Ryan Johnson, and I'm a corporate healthcare attorney and shareholder at Frederickson and Byron. Frederickson is a full-service law firm based in Minneapolis with offices across the Midwest and in China and Mexico. We serve as legal counselors, business advisors, and strategic partners for many innovative life science and healthcare companies, ranging in size from the smallest startups, sometimes just a founder with an idea, to some of the world's largest medtech and healthcare organizations. If you'd like to find out more about Frederickson, you can visit fredlaw.com or contact me after the webinar.
My name is Christian Corello, and I'm the head of strategic growth for Mobius Medical. We are an Australia-based contract research organization now with U.S. operations and headquarters in Minneapolis. Mobius Medical is not your typical CRO, and that's by design. In addition to world-class first-in-human and early-stage medical device clinical trials, we are our client's strategic business partner too. We offer direct access to a full suite of subject matter experts ranging from regulatory and commercialization guidance to business strategy and capital raise advice. And every one of our services are designed specifically for medical device startup and scale-up companies, just like you. If you'd like to find out more about Mobius Medical's unique CRO services, please contact me after the event or find me on LinkedIn. Additionally, our mutual friends at Medical Alley can always connect us. Thank you.
If you are a startup, scale-up, or even an established organization looking for assistance and advice in some of these areas, please do reach out to our partners. But now let's get on to our program with Mickayla. Mickayla, you're probably or a lot of the attendees are probably going to be familiar with you, but would you mind introducing yourself a little bit and introducing Groove Capital as well?
I'd be happy to. Hi, welcome everyone. Thanks for joining us. I'm Mickayla Rosard, partner at Groove Capital. So Groove is a early stage venture fund as well as a angel network. We are focused on investing in Minnesota startups at the early stage. So for us, that's pre-seed at a high volume. So on average, we're investing in about 2 new deals a month. We're industry agnostic, of course, playing to the strengths of Minnesota because we're focused on Minnesota companies. So that covers a lot of healthcare deals. In addition to my role at Groove, I also am leading the angel activation work for Forge North. The goal here is to bring in more early stage capital to the state of Minnesota. So activating more individuals who have the means to participate as angel investors. I've been leading that work for 4 years now, so have really had the opportunity to kind of get into the psyche of the local angel investor and understand what their motivations are and kind of how to activate more of them. And then many of you may also know I'm the creator and kind of architect behind Angel Fest, which is an annual conference focused on early stage investing and really kind of adding a local lens to the conversation. So the focus there is on the investor, but we of course need to showcase and constantly pull in founders' views as well to make it a meaningful and robust discussion.
Thank you so much, Mickayla. I'll just say I have a couple of starter questions, but as we're having the conversation, I would encourage the attendees to just pop their questions in the chat, and we'll make sure to answer those later on. It is an Ask Me Anything after all, so we do want to get you involved as much as possible. I'll start in the middle, if you don't mind, with really activating the potential angel investors and making sure that there is enough early stage capital to deploy. How, in your experience, has that process been? Is it really difficult to even find new potential angels, and how have you been able to leverage the ecosystem here?
So if you were to ask me that question on the first year of doing the work, I would have been like, I have no idea where to find these individuals. And now that we're 4 years in, I feel like the systems and the structure, and there's been some element of experimentation. We're really starting to find momentum. So it's not going to sound like an aha moment, but really a lot of investors get pulled in, especially first-time investors, through a trusted person they already know. So certainly that could be another early stage investor, that could be a coworker, that could be a founder. And so it's building that referral base is super important, but also it's really, mindful to build the community. We want to continue to coach Minnesota investors how to be good and better investors. And so in our market, like a really great example of this would be like, if you're gonna say no to the founder, like it's a kind thing first to say no, but get to that early so you can cut the founder loose and they can, go focus on other investors that are better aligned with what they're building, which is counterintuitive for a lot of Minnesotans who want to just, be really polite and they don't want to have difficult discussions or upset anyone. And so it's kind of reinforcing those good practices. But in general, the framework that we've used is kind of a 4-part framework to finding early stage investors. The first is awareness. In our market in particular, a lot of individuals don't know that this asset class is available for them to invest in. And we have some culture kind of barriers in here too. So as Midwesterners, we don't really like to talk about money or investments. And so often what that means is there's an information exchange that doesn't happen the same way you would see in other markets. So awareness is huge. Then it's building education. We've put together a lot of different programs to build the muscle on early stage investing. For example, this year alone, we've run 5 different angel cohorts to bring in new individuals. One in particular with a lens on how to invest in healthcare, knowing there's some nuances there for individuals. And then after kind of the education piece, making sure that they have a community of other investors. Nobody wants to feel like they're on an island on their own, and that's true for investors too. And then the 4th piece is activation. So I like to kind of say, like, write the damn check. And so making sure angels know how and where they can go to start actually deploying cash is really important.
You, at the very beginning, you brought up a very good point, which is something that we hear from companies. A fast no is maybe the single best response that they can get from investors, because it's pretty rare that they will hear, yes, I want to invest, but getting to a fast no, and ideally with a reason why, is one thing that founders keep mentioning to us. How important is it, in your opinion, for startups to be targeted in their approach when they're talking to potential investors? Is it a better idea to address as many investors as possible, or taking a more narrow approach to investors that might align better with where they're at?
It depends on where you're at in your capital raise. If you are already a successful founder, if you're kind of brand new starting this, generally speaking, anytime you can be targeted and focused, it's important. At the end of the day, it's a sales process, and so like you have to be able to manage those relationships, manage kind of the conversations that are open, follow up with those conversations. And so if you're taking too broad of an approach, you're just not going to be able to be as kind of targeted and successful. And I don't know who would be and is investing in deals that are just cold, coming in through email or coming in through LinkedIn without any sort of context or research or background. Like for most people, like if you're blasting me on LinkedIn with your startup idea, it's kind of just an automatic delete. Like it's totally not worth your time. So figure out where your relationships are. Make sure you've got solid, relationships built in trust, built on kind of your own personal brand of hopefully following through and executing on things. And definitely start there, and then continue to ask for referrals from those early adopters and people that are really early champions in what you're building. I think that's going to probably be the best approach. A saying that I heard recently, and I think it's so important, is like business moves at the speed of relationships, and that only can go as fast as like the trust that's built. And so especially when you're talking about people investing their own personal dollars in your company, you just have to really put time into that relationship to make sure that it's a good fit and that it makes sense for both parties.
This is probably even more important at the stage that Groove is investing at the pre-seed stage, where really team and relationship probably is what you're looking at the most. Is that a fair assumption? And if
Totally
so,
fair assumption.
what are
Yeah,
some?
I guess for the audience, like my lens coming into this conversation is going to be very early stage. So we're often coming in as the first institutional investor for a lot of folks. And that's why in our model, having the angel network sitting right beside the fund makes sense, because we are investing at that early stage. Of course, if we were investing in Series A or B or C, like it doesn't make sense to have an angel network because there's a differential in the stages that the fund and the angels would be participating in. So yeah, that's a very fair and important kind of call out, because that's where my kind of experience and just lens is going to be.
One more question when it comes to pitching, I guess. What we sometimes hear from founders is, I am getting constant advice. I'm getting on my pitch deck and just the value proposition that I'm communicating. I'm getting conflicting opinions. Do you think that there is ever an opportunity to put too much work into a slide deck or into pitching?
Yeah, certainly. I think that can definitely happen. The thing though, it is important to continue to get feedback and take that feedback to heart, especially if you start hearing feedback that is similar to each other. I think where you might find yourself like, okay, I've over prepared, is when your feedback kind of totally loops all the way around and you're like, okay, I'm back to square one and starting on this. Building your pitch deck and pitching is, as with anything in life, you've got to take the advice that makes sense. And sometimes you've got to just let some of the advice just kind of fall to the side. As the founder, that's really kind of on you to understand and to synthesize what is best for your company and what makes sense. Let me share a real life example as it relates to kind of over preparedness on the pitch. So I had the privilege of judging the Cup finalist round this year. And one of the finalists, in conversation with her after the fact, was sharing a kind of her personal story pitching the company. And she was saying how, in kind of an effort to be over prepared, she would kind of say, this is important, and here's all the data and research why it's important. But interestingly enough, when she kind of condensed her pitch down to just this is important, without having all of the ancillary data. She still had it if any investors wanted to dig in. It actually strengthened her pitch because it didn't seem like it came across as more confident and just matter of fact. And so that was a really interesting conversation to hear how sometimes overcomplicating and over-explaining can actually undermine us.
I'll follow up with one question from the audience. At the early stages, what are some of the minimum requirements or key documents that even angels or pre-seed investors want to take a look at when it comes to writing a check?
Certainly. And this is, of course, going to be different depending on your particular company, your industry. Certainly, you're going to need your pitch deck, some sort of executive summary, financials, knowing that at least in the stage we're playing, those are going to be pretty limited. You don't have many years of operational history to go off of. On the piece of kind of looking at the financials, I should note most early stage investors know that that's not going to happen. But the point of looking at those and evaluating your financials is, one, to understand how you're thinking about your business. Like, are you willing to go big? Are you willing to really kind of bat for the fences? Or are you kind of comfortable being a bit more conservative? And maybe that is reflecting in your financials. It often shows up in your financials. And then, of course, the assumptions. So like the key thing that we're learning when looking at that is understanding, do you understand how your business makes money? Like, what is your business model? And understanding kind of those, just the assumptions that get plugged into that financial. So those are going to be some key information. Of course, if you've got IP, the patents are going to be important. Any sort of additional kind of information really specific to what your tech is, what you're building, or kind of if it's a device, what that looks like. In this particular case, also understanding if you've taken any non-dilutive funding, so the general cap table, but understanding how you've financed so far is important to understand. And then also, I would say kind of understanding that roadmap of regulation and making that easy for investors to understand where you're at and what still needs to be done.
Since you mentioned regulation, we had another question come in from the audience just now. Are there, or do you at Groove have any specific regulatory or reimbursement requirements or milestones that the company should hit for you to be investable at that stage?
So we're going to look at this on a case-by-case basis. Because we are industry agnostic, it differs depending on the particular company. What I will say is, obviously in this case, like we're comfortable investing in deals that are pre-revenue. That's kind of a given if you're investing in device. And we're comfortable investing in companies that are still in that kind of regulatory process. I think what's really key for the stage that we're playing in, founders have to still be able to show traction. So they have to be able to still show that they're making that same kind of momentum and progress to getting those regulations and key requirements. But then also it's really like important to understand, like at the stage that we're investing in, so much of it is not necessarily just the particular device technology. Like the science is obviously super important, but we're also really looking at the founding group and trying to understand, do they have the capabilities to take feedback, to pivot, to oftentimes really clear communication and being able to synthesize important and difficult information in a easily accessible manner. That's going to be important, not just for your fundraise, but for building your team, kind of getting to your customers, all of those sort of things. So I can't underscore enough how much the founding team in our stage really gets factored into this as well.
Is there a preferred method or investment vehicle that you are you are using at Groove?
I love this question because it's a zinger, it's a hot button item. For Groove, no, we will invest on convertible notes. We will invest on safes. We will do straight equity. But that is not true for every early stage investor. There are plenty of folks that have really strong preferences one way or the other. I will say though, when it comes to kind of the structure and the investment vehicle, one thing that is very important is making sure that your company is structured as a corporation. If it's structured as an LLC, that really is a challenge for the QSBS 1202. And that's a really important tax incentive for early stage investors. So if it is an LLC, we'll work with the founder to make sure that it's something that they're willing and able to convert to a corporation right away, or as soon as possible. That is definitely kind of an item that is discussed and has to be.
Yeah, you bring up a really good point. It's one key decision that founders make at the very beginning of the process, not knowing that that could significantly affect the returns, not just of them, but also the investors down the road.
Well, and it's not just for the taxes. So it's for the long-term taxes and the capital gains, but it's also from an individual annual perspective. So for those that understand LLCs, it's a pass-through entity. And so if I'm investing in your company and it's structured as an LLC, I have financial and legal obligations to it. So if you are making revenue down the road, but not actually distributing any sort of distributions to your investors, I'm taxed on that, even if I haven't made any sort of profit from your company yet. In addition, like let's say things weren't going well, if the company stopped paying their employees, for example, as an investor in an LLC, I'm legally responsible for that. And so it just puts your founders in a really, really vulnerable position. You can, account for some of those in your operating agreement, but honestly, it's not the best structure. Like you should be set up as a corporation if you're looking at venture.
Yeah. You mentioned earlier some of the Midwestern particularities, both when it comes to maybe the ambition of the startups, but maybe also on the side of the investors. Have you in your career seen any sort of change in how people invest and run startups in the Midwest?
I'll take the first part on the how they invest, and then remind me to come back to the second part of the question. Yes, there's definitely things changing in the angel or early stage and venture landscape, and this is happening on a national level, but we're seeing it local too. So angel investors are getting younger, meaning that they are starting to participate in angel investing earlier in their life cycle than what we've seen in the past. So that's an interesting demographic note. We're starting to see more women in particular participate as early stage investors, which I think is a really, really important opportunity for a lot of different startups, companies, founders, all that good stuff. We're also starting to see the background of like work experience broaden out. So traditionally, angels, as you guys could imagine, were successful operators, maybe founders themselves. And that's what kind of brought them into the early stage landscape and angel landscape. We're now starting to see folks starting to get interested in angel investing. Everyone from professors to pilots to nurses to folks operating car dealerships. Maybe they made their money in real estate. And so I think that provides opportunity, but it also means for founders, you have to kind of understand and kind of suss out a little bit more of that to make sure that your investor groups that you're bringing in are smart money. They have kind of a value beyond just that check, or at least be aware where their limitations to kind of coach you might be. But ultimately, I think it's a really strong thing, especially in the Minnesota ecosystem where we don't have a lot of people participating as early stage investors. It's really, really great to be able to see more diversity come in, folks with a broader viewpoint on things. it matters. I think one of the things that I would say has shifted the most is the ecosystem. So if you talk to founders that got started 5 years and later, maybe even, five's kind of on the, it might be closer to like 7 and later. The startup ecosystem was not organized in the way that it is now. And some of those service providers, some of those entrepreneurial support orgs, they weren't in existence, operating, maybe not as robust. And so that has been a thing that has changed and shifted. There are a lot of tools and resources for founders, regardless of the stage, that really can help them get started. And then you also kind of have this overlay of grant dollars coming into the ecosystem, really specifically to target startups, or even looking at Launch Minnesota, which is a new government organization. These are all kind of public-private partnerships, all government, kind of making the ecosystem a little bit more sophisticated, and allowing more dollars to flow in. So I think the grant that I'm leading with Greater MSP on angel activation, this is a federal grant. We'd never received any sort of grant like this before, but it's adding significant and meaningful capital to the ecosystem. I'm sure at some point we'll probably kind of touch on the MedTech 3.0 designation, but the next phases of that is hopefully also unlocking some government funding. And so I think the organization and sophistication of the ecosystem has changed for founders. And one thing that's interesting, kind of tying those two pieces together, in most startup ecosystems, you've got your successful founders, and then once they've exited or kind of left, often there's some portion of them that are investing back into the ecosystem. And that is true in Minnesota. But there's this awkwardness. When you talk to those founders, there's this element of, this ecosystem didn't exist when I got started. Like, I had to do all of this on my own. And so there is a little bit of an awkward dynamic in that when you're talking about trying to empower that next wave of investors who are successful founders.
Since you brought up the ecosystem, some VCs have taken initiative to kind of build out their own platform whereby they support their portfolio companies. Is that something that Groove has done as well?
Yeah, so obviously, like, we're not successful if our founders aren't successful. And so making sure those individuals are supported is really important. Our model is really built on the premise of being collaborative. And so one, it's stage appropriate. Like, because we're pre-seed investors, we're not demanding a board seat. A lot of our companies don't even have a board yet. So it wouldn't be a fit for what we're doing. But instead, we're taking our 250 investor group, and in real time, as founders are reporting to us on a monthly cadence, we're asking them where they need help. And then we're using kind of our infrastructure that we've built to match make those come as they come in. So founders building out a sales team. Okay, and they need help with that, and they're asking for help with that. Then we're going to pull in using our database and kind of infrastructure to match that with investors and do one-on-one curated kind of matching. We found it to be a lot more successful if you directly ask someone, hey, this founder could use your help. Are you willing to help? We also still, any requests that are coming in on a monthly basis, we will still kind of promote those as like, hey, if anyone has referrals or recommendations or time to give, these are the areas they need help. But it is the one-on-one matching that is super important. And it's fun to see because our angel base is really broad, and also because our founder base, we're industry agnostic, is broad, you see some kind of cross collaboration that you might not always see in other markets. A perfect example of this, it was a healthcare company, and she took on a sidecar investment from one of our tech investors. And he was very straightforward, like, I don't really understand what you're building, so I'm not going to be able to help you, but I believe in what you're trying to accomplish. And she was like, actually, I do not, like, if you search my company name, I'm like on page 30 of Google, and it's like that pebble in my shoe. I know it's important, but I haven't had the chance to fix it. And so in this conversation, he's like, okay, well, if you're willing to give me like the keys to the kingdom, I'll like jump into your website and check out your kind of SEO stuff. And within 10 minutes, he had it fixed. I should also note, when you search the company name, what came up as like the top search item was like a gun manufacturing company that was super irrelevant, just kind of unsavory kind of website. It was just bad brand kind of connection. And so within 10 minutes, this tech investor had her company as the top on Google. And so it is one of those things we always encourage our founders, like, vocalize where you need help, small and big, because if you're not vocalizing it, you are going to be less likely to get the help and resources you need. And that can be difficult. It can be humbling. But what we're really trying to build at Groove is an ecosystem that is encouraging and championing those kind of connections. We're different in the sense we're not gatekeeping things. Other angels networks would be very remiss to have their angels like post that like they're connected to them on LinkedIn. We encourage our folks to do that. We also encourage cross collaboration between our investor base and our founders. Other venture funds would never mix their LPs with their portfolio companies. And so we're really trying to make sure that we're creating a collaborative, open, transparent kind of ecosystem. And I think it's working. I think it matters. And I think people are kind of drawing into that energy.
I definitely agree with that too. I think, ultimately, they're building a business, and business is done by and among people. So, building those relationships and building that trust is something that I think from a long-term perspective, at least, is the right approach.
There's the adage, and I know plenty of people have heard it: if you ask for money, you'll get advice. And if you ask for advice, you'll get money. And so it almost is one of those things too, like if you can kind of bring people into your building and your plans, it makes it easier when you're on your next raise to go back to those individuals and ask for money. But I should also note, because we're talking like very hands-on, coachy, collaborative, one thing that I've been trying very hard to explain to our investors, because when I'm thinking about bringing more folks into the ecosystem, I want to make sure that they're getting good practices, not necessarily just taking habits that are not well suiting to investors or founders. So one thing that's important to note here, there's the life cycle of the company. There's a point when the angel investor needs to know that they need to step back and be supportive if something comes up, but they are no longer kind of actively coaching at that point, because it's likely that the company has grown outside of the core competencies that person would probably be able to give. And that's really natural, but sometimes it bears just reminding folks.
Thank you. How much or how often do you interact with later stage investors, the investors that could be follow-on investors for the founders that you invested in?
Yeah, so I mean, it's important, especially in our market where there's not a ton of capital partners, making sure that we have those later stage folks identified, understand their theses so we can be making recommendations is really important. I will say, just from an ecosystem perspective, for later stage, like after seed, Series A, and kind of once you get beyond that, it is challenging, especially maybe not so much for like some of the device and healthcare companies, but for folks kind of in other industries, there's not a lot of capital partners that are funding those late stage. I do think in this particular kind of industry sector, there's a lot of different strategic investors that are connected local. So there's a little bit better organization in this particular industry.
Yeah, I would definitely agree. Just by the sheer concentration of the strategics and some of the well-established companies, I think healthcare in particular is in a better position than maybe some of the other industries. Going back to Groove, you mentioned that you mostly look at the founding team. What is it that you look for in the founding team? You've touched on it a little bit, but I don't know, is it 3, 4 main criteria?
So we've got a scorecard that we've built out. And with that scorecard, the founding team is an important piece. It's one of many. It's all kind of a weighted scorecard, so we're not over-indexing on one particular thing over the other. But when we're looking at just the team piece in particular, of course, if the founder has previous experience, research shows that that individual is likely to be more successful in their next raise. I will say in Minnesota, it's not as common that you see serial entrepreneurs, or at least not yet. And so that's not always kind of a easy indicator. We'll also look for if there's kind of a founding team, making sure that those dynamics are healthy and look good. Sometimes it can be really confusing if someone's listed as the CEO, but then the other kind of C-suites, the one that's always doing the responding to the emails or kind of chiming in. And so that can be an indication that maybe there's not clear roles and responsibilities, or maybe not healthy communication or dynamics.
Mm-hmm.
And so you want to kind of continue to suss out some of those pieces. The best teams are teams that have worked together. I also have a saying, you can't work together until you've worked together. It's very Midwest. I'm sorry, but there's an element to that. Like you learn a lot about someone when you have the opportunity to work with them. Like, how do they deal under pressure? How do their values align to yours? Are they ethical? And so those are all really important things. And so founding teams that have had the opportunity to work together tend to be stronger teams. And then also kind of understanding their ability to pull in other folks. So are they aware of where their gaps are? And are they able to identify that and build the team to fill those gaps? But then we also have some like kind of anecdotal stuff that like my business partner Reed will like to say, founders that are collegiate sports athletes tend to be really great founders. There's an element of competitiveness. There's an element of really camaraderie and team building, which can make for some really healthy and great startup kind of environments. And so we're kind of assessing all of this information and bring it into real time. There's no like silver bullet on any one of these. Like if you can check this exact box, a lot of it comes down to being honest, trustful. Like if you're going to put people on your pitch deck as advisors, they better be advisors and they better know that they're on your pitch deck. So some of it's just pretty like basic, but like you got to make sure that your story is really consistent.
Really terrific summary on the importance of just doing early stage business. Mickayla, any closing remarks, notes, or recommendations for founders?
For founders, dream big, keep building. I get inspiration by our founders. I think there's something really special, especially in the Minnesota market, folks who are willing to see a problem and solve it and build for it. And I think everyone on this webinar knows like the work that's happening in this space in particular in healthcare, like it will seismically impact how we live and our health in the future. So keep going.
Thank you so much. That was terrific. Well, if you are a founder and you would like to connect with Mickayla, I know Groove has a contact form on their website, but if your company aligns with Groove's investment thesis, please feel free to reach out to me or any of my teammates at Medical Alley, and we'd be happy to connect you with the Groove team. But also, if you're looking for other investors, we're more than happy to facilitate those connections as well. Mickayla, thank you so much. Thank you so much to all the attendees, and we'll see you at the next Ask Me Anything.
Thanks so much for having me.